Hi, I am Apurva and I welcome you to yet another insightful episode of The Right Choices with Oracles of Dalal Street. Our aim on this show is to curate actionable strategies from real world stock market heroes so that you can make the right choices in the markets. We have a very special guest joining us today, all the way from California. Our guest has been associated with global financial markets for more than 17 years. He's a graduate in finance from Fairfield University, and he's also a chartered market technician. He wrote his first blog in the year 2010, and since then there's been no looking back. He's been invited to various media houses like CNBC, Fox, Bloomberg, and many more outlets for sharing his thoughts on the markets. He's also been invited to universities like Duke, NYU, and University of Chicago. Currently, he's focusing all his energy on growing allstarcharts.com, which provides institutional grade research to investors in US and India. When he's not busy with the markets, you can find him cooking or playing baseball along with his friends. So let's welcome JC Parets to our show. Welcome to the show, JC. We are pleased to have you here.
Thank you for having me.
Yeah, thanks a lot for accepting our invitation and accepting to share your insights on the markets with all of us and our viewers. I'm sure that the conversation will be truly insightful and we'll get a new perspective of trading from a top-down approach in the markets. So looking forward to it.
Me too.
Yeah, so JC, I'm very excited to get into the details of the top-down approach. But before we do that, we'd like to know more about you. You've been into the markets right since your college days, and you've been graduated in finance. So why don't you share some of your background and your journey in the financial markets?
Sure. It's fun, thinking back, because you always, when you're younger, you try to do the best you can. You try to do the right thing, try to, get good experiences, try to, bet on the right people. So like looking back, it's just fun. I was in that area last week or 2 weeks ago, back in Connecticut, where my school was, and where my first internship was. And, I hadn't been back there in a few years. So it was fun reminiscing. I was a baseball player growing up in Miami. My family's from Cuba. And I was a pretty good baseball player. I wasn't like the best baseball player, but I was good enough to help me get into a better school than perhaps my grades would have allowed for. Fairfield's a great school, and prepared me not just in the classroom, but helped me get an internship at Merrill Lynch. This is when Merrill Lynch existed many years ago. It was a great opportunity for me. Great experience. For me, it was love at first sight in the market. It always just made sense to me. It always attracted me. Math was always interesting to me. Logic and common sense have always interested me. So fundamental analysis and having to trust people, never interested me. Economists, like none of that stuff makes any sense to me, because price moves first and the economy moves second. And fundamentals are numbers that you need to trust from analysts. These are numbers you need to trust from auditors. These are numbers you need to trust from CEOs. I don't trust any of those people. And as investors, you shouldn't either. They're, in many cases, they're lying to you, or in other cases, they're just wrong, right? They're not bad people. They were mistaken. Both of those happen quite often enough that we just ignore it completely, and we focus on price, because price is the only thing that's going to pay anybody. So if that's the case, and we're only going to make money if we sell things at higher prices than where we buy them, why wouldn't our analysis both begin and end with the study of price? And, this is something I know now, but at the time when I was 22 years old, or 21 years old, first getting into Wall Street, getting my feet wet, I didn't know those things yet. These are lessons I had to learn the hard way, that, fundamentals are just a guessing game. Humans cannot be trusted because they can be wrong or just lying maliciously. Neither one of those is a good scenario for investors, and they happen quite often. So these are lessons that I had to learn the hard way over the years, And then it just made sense to get my CMT, right? So this is like 2005, 2006. It's amazing it's been that long. And then as soon as I started reading Edwards and McGee and John Murphy and all the classic technical analysis books, I was like, oh, okay, this makes sense to me. Got it. Supply and demand. Oh yeah, more demand than supply. Price goes up. Yeah, totally. I get that. Oh, more sellers than buyers. Price goes down. All right. See, now this makes a lot more sense to me than the PE ratio, or what the CEO said this afternoon. Like, who cares about any of that stuff? You could really see all of it in supply and demand. And it took me, quite a few years, number one, to realize that was even a thing. And even to this day, I have been a technician. I look at more charts than anybody in the world. If there's anybody in the world that looks at more charts than I do, I could probably tell you who they are, and I'm friends with them. So I'm at the very least, I'm in the conversation. And the bottom line is, you see prices moving first, right? Prices move. And then the media and the journalist community then tries to justify those price movements with reasons and stories. And as human beings, we need to be told stories. It's perfectly natural. Goes back to evolution, 70,000 years. We've been telling each other stories. So as humans, it's perfectly natural to want to hear stories and be told stories and tell people stories. It's perfectly natural. But when it comes to investing, you have to take these fairy tales out of the equation. We're not here I'm not Mother Goose. I don't want to hear about your stories. I want to know what is actually taking place. And you can see that in price. And you could save your stories for adults that still need to be told bedtime stories before bed. I don't.
Yeah, so absolutely. So price action is what will eventually make money for you, and that's what a trader or an investor will or should actually bother about. And I see where you are coming from, like in this particular section where you spoke about the CEOs and auditors, and they might not necessarily be wrong people, but they may have went wrong, or maybe they have done things which are wrong. And the best example of those particular things was the global financial crisis in 2008. And you have been there, seen those things, those companies go belly up very closely. So can you share some of your experiences about those days with our viewers?
Yeah, it's funny. We were just talking about that with some friends of mine who I was with during those periods. A couple of weeks ago, I had dinner with them. We were laughing about those times. I had, by the end of 2007, I had already completed level 2 of the CMT. So I was studying for level 3 as we were getting into 2008. So I passed level 3 of the CMT that summer. But I was already studying for level 3. I was already advanced enough to understand the way supply and demand dynamics worked, to understand distribution patterns and understand accumulation patterns. And I was aware enough to know that we were seeing relative weakness out of financials, which is just classic of tops. We were seeing just massive distribution in the Dow Jones Industrial Average, S&P 500. Market breadth was non-existent. By the highs in October of 2007, there was only a few stocks still making new highs. So breadth deterioration, distribution, just everything across the board. Point in my career, I had not seen a bear market yet. Yeah. So I was actually very excited for the bear market. It was like, and my friends were not happy with me, my older friends, because they had been through bear markets before, and they're like, JC, we don't want that. We hope you're wrong. And I was like, well, I don't hope I'm wrong. I'm actually pretty excited of it. I had never really shorted stocks yet at that point in my career because there had been no need. I started working in 2003 as an intern. I didn't have the ability to buy or sell securities at that time. That didn't come until a year later. And at that point, we were buying securities. There was no reason to be shorting stocks. We were in a bull market. We're buying energy stocks, financials. I remember buying, first stock I ever bought was a bank, New York Community Bank Corp, NYB. Paid a nice dividend. It was like $22. It was a very exciting time, and then so by the time 2007, 2008 came, we were super bearish, short every bank, I remember the day Bear Stearns went under, we covered our shorts. And I thought I was like the smartest guy in the world because I covered all my shorts the morning Bear Stearns went under, which was in March of 2008. So I remember vividly, because thinking to myself, well, I've been short these bank stocks for 3 months or 2 months at that point. Bear Stearns just disappeared. Like, if I'm not covering my shorts now, like, what am I waiting for, right? So that was my thesis at the time, and I was very happy about it because it happened. I was in Miami when I got the news that Bear Stearns got bought out for $2 a share, and I was very excited. My parents thought I was crazy because I was at my parents' house and then going back up to New York City the next morning. So I flew into New York City. I landed before the market opened, sold, we weren't short. We were long inverse ETFs on the banks, leveraged inverse ETFs. So we were selling them that morning, and I thought I was so smart. If I was really smart, I would have flipped the trade and bought them all because the opening print that morning was the low, and then the market ripped from there. So then I just felt like a fool. So that, even when you're right, the market still makes you look like a fool. And that's something that I learned early on as well. No matter how good of a trade, there's always a lesson, right? What could you have done better? What could you have done differently? If you're so smart on the stock that you bought that went higher, why didn't you own more, right? If you're so smart, right?
Yeah.
So no matter how good of a trade, there's always a lesson.
Yeah, and we may think that we may be the smartest person, but there's always someone smarter than you. And in general, the market as a whole is smarter than everyone, every participant. So that's the thing that we must always remember.
That's right.
Yep. So JC, now getting into the top-down approach to trading. So I want you to show us some charts, or begin with a particular chart which you would recommend a retail investor to look at before he starts investing. So for me, I would see, let's say, the US bond yields, which is the fountain of capital all across the world. So money flows from the US to all the other markets. So do you look at the US bond yield or anything else that to start your analysis with?
Definitely. When we do our analysis, if we're having a conversation, how do you have a conversation about the stock market without talking about bond yields? You can't. You have to talk about interest rates to have a real conversation, or at least conversation with me, I should say. Other people might not look at it. That's their problem. For me, you can't have a serious conversation about the stock market without first talking about the bond market, understanding what's happening in the commodities market, understanding what's happening in Forex markets. Before we even get to the stock market, we are analyzing all those other markets first. To your point, the biggest market in the world is the bond market. So if you want to know, right, so somebody's, a retail portfolio, somebody is managing their own account and their portfolio goes to zero. Nobody cares, right? It's not going to affect the market. It doesn't matter. What moves markets is these massive multi-trillion-dollar asset managers. I mean, there's just so much money being put to work by all these different groups of investors. That's what moves markets. And they have so much money that they can't hide where it's being allocated to. They can't hide it. It's just so big that you can't miss it. And if you're looking at the bond market, you could see what's going on, right? So you can use the information that the bond market is giving us to make decisions in the stock market. People are like, JC, I don't trade bonds. That's boring. That's for old people. What do I need bonds for? Give me Tesla. Give me the crypto. It's like, settle down, relax. We'll get to the Tesla and the crypto, but we need to understand what's happening in the bond market because that's the big boy sandbox, right? That's where the big boys have to play. They don't have a choice. So we could really see what's going on, and we could see U.S. 10-year yields making new highs, U.S. 5-year yields making new highs. Crude oil and the CRB index have gone up 8 consecutive weeks. The CRB index, crude oil is now making 7-year highs. So when you see all of these things, higher interest rates, what are the sectors that benefit the most from higher interest rates? It's energy and financials. So here we're looking at an ETF, EQRR. And this ETF, it's an equities for rising rates. And it's basically an ETF of stocks that do well when interest rates are going up. So this is the blue line. So then when you look at the components of that ETF, half of them are financials and energy. So then what we did is we took the financials and energy and equally weighted the index of banks and energy stocks. And what do you know? Both of these lines look exactly the same. So if you think interest rates are going higher, which the bond market clearly does, and I'm no one to argue with the bond market, right? I don't trust people. I trust dogs and I trust the bond market, right? That's how I live my life. And if we're going to be betting on higher interest rates, I think financials and energy is where we need to be. With crude oil, this chart says 6-year highs. It's actually making 7-year highs now. How do we not bet on these? And then just from so you can understand what the market has done this year, the answer is nothing. People are like, well, JC, the stock market, is due for a correction. It's like, if you think the stock market is due for a correction, where have you been all year? Where the majority of stocks have been correcting. I have another chart that I want to show you. Let's see. Where is it? Here we go. So here's the NASDAQ. People are like, oh, stocks only go up, JC. Stocks only go up. It's like, well, half the NASDAQ stocks are down 20% this year. And 20% of the NASDAQ is down 50% this year. The average NASDAQ stock's down 30%. So if you're waiting for a correction, my question to you is, where have you been? So this is classic year 2 of cycles. So doesn't what happened off of the March lows last year look a lot like what happened off the 2009 lows? You asked me to tell you about that time. Well, this reminds me a lot of that. And then what happened in the year 2 of that cycle in 2010? It was a messy market, right? Very similar to what we're seeing today, right? Very similar to what we're seeing today, messy market. By the way, this is the value line geometric index, which represents the median stock price change. So as opposed to a mega cap driven S&P 500 or NASDAQ 100 or Dow Jones Industrial Average, we're looking at your typical stock, the median stock. And you can see here, it's done absolutely nothing all year as high beta has, so we're just to finish up on this chart, the black line is high beta stocks versus low volatility. And as you can see off the lows last year, the high beta stocks were outperforming low volatility. So if these can get going, the value line index gets going, chances are the stock market is going to be in really, really good shape. So my point is, we've done nothing in this year 2 of a cycle. Off of the March lows in last year, it was the best 52-week period, I think, ever in the stock market, or like the second best ever, right? And it reminded me a lot of 2009. So 2021 has been a lot like 2010. And if you recall, the thrust off the 2003 lows was a lot like the thrust off last year's lows. And what happened in 2004? It was a messy market. Go back to the thrust off the 1982 low. What happened in 84 after that huge 1983? What happened in 84? Messy market. We saw the same thing in 1974, major move. 1975, one of the best years ever. What happened in 76? Chop, chop, chop. So, for me, I look at the value line geometric index up only 14% at this point since 2018. And that's in the United States. If you look internationally, you'll notice just how many stocks are below those 2018 highs. A lot. So, to me, I think this is year 2 of a cycle. I think risk assets are just getting going. You see, there's just a shortage of risk assets. There is more money around the world being allocated into stocks and commodities and crypto than there are risk assets to feed that demand, right? So it has nothing to do with the Federal Reserve balance sheet or the Trump or the Fed or the consumer or the COVID. It has nothing to do with any of that. There's simply more money around the world being allocated to risk assets than there are risk assets to feed that demand. And if we've learned anything throughout history, is that if there is more demand than supply for something, prices are going to go higher. And that's what we see for commodities, particularly energy and base metals and agriculture, and stocks and crypto.
So one of the things which you mentioned is that people are chasing riskier assets. And one component of these riskier assets is the emerging markets basket. And India is also part of that emerging markets basket. So what do you think about India and how is it likely to pan out over the next 2 or 3 years?
I mean, it's hard to blanket all emerging markets the same way, right? As you're well aware. What does the Indian economy and Indian stocks have anything to do with Brazil? They're very, very different. Or Russia. or China. They're very, very different. And you could see it in the price. Nifty 50 continues to make new highs, and Brazil looks terrible. China looks terrible, right? Russia's doing pretty well because of energy, right? But, you know, these are, you know, emerging markets for the most part have been struggling, except those in energy. You know, like I said, look at Russia. Canada starting to make moves as well. You know, what are we talking about? Energy, and not that Canada is an emerging market, but, you know, with respects to commodity focused areas, you know, Canada and Australia are right there, and they both are making highs. And when you think about their exposure, what do you think? You think energy and financials. I mean, that screams Canada.
So basically natural resources is what makes these countries.
Right, and India is not that at all. Right? Nifty Energy looks amazing. You know, just continues to make new highs. Nifty Energy. See, do I have the Nifty Energy here? Here we go. So as you can see, we have a lot of Indian charts here. As you can see, plenty of them. Here we go. Here's Nifty Energy. That's what we call an uptrend. Apurva. That is what we call an uptrend. I mean, there's just nothing not to like about this chart. It's an uptrend. When you're thinking Nifty Energy, how do you not think of Reliance, right? So when you look at, you know, that 2,400 level or above that, I think you own Reliance. I think you continue to bet on higher energy prices. As I mentioned before, oil making new highs, you know, credit spreads are continuing to narrow, pointing to further evidence of risk appetite from investors around the world. You know, and with respects to relative strength, we want to be buying the things that are working. We want to be, you know, institutional money goes to where it's been treated best. And it's been treated best in India, in energy, in financials lately, not in bonds, as bonds go down with higher interest rates. So those are the things that we're watching. You know, treat India on its own. Don't worry about the rest of those emerging markets. They're different.
So JC, you use a lot of relative strength charts, and relative strength charts, I believe, are truly underrated. So even I personally feel that relative strength charts are very helpful, and very few people here in Indian markets use them. So they can be used for pair trading. They can be used to allocate your limited pool of resources to stocks or sectors which are outperforming. So can you throw some light on one thing, which is how do you, or what is relative strength, so that our retail investors who are watching this show understand them, and how do you use them in your analysis?
Yeah, that's a great question. So, you know, and it's funny because at the end of every year, you know, we always talk, I always get asked, like, what did you learn this year? Like, you know, all the bloggers and all the media networks are like, JC, we're asking everybody what you learned. So, like, I always think about it because I have to think about it because I have to give an answer. And last year, my answer was that relative strength is underrated. Now, what's funny about that is that I went into last year knowing that relative strength was underrated. I already knew that. I had already figured that out. And relative strength, to me, is the most important indicator in the world after price. And relative strength is really just a derivative of price because you're comparing one asset to another. So technically, relative strength is still part of the price category, which is why I feel very comfortable putting it up there on the list. You know, price, relative strength, momentum. Relative strength is right there with price. Momentum is a far, far, far third. Relative strength is right there with price. Why? Because things in uptrends don't just do well on their own. Strong bull markets don't just go up. They also outperform their alternatives. If you see the stock market in a bull market, stocks are going up, sure, but they're also probably outperforming gold. They're probably outperforming bonds. They're outperforming their alternatives. Not to mention, when the stock market is falling, right, and there's liquidity. People are selling stocks. The biggest institutions in the world, the only way that they can participate in the stock market is that if there's liquidity, because they're so big that if they pile drive into a stock, they're going to shoot the stock up because of so much demand. So they're looking for opportunities when there's a lot of liquidity, when there's a lot of sellers, so they could say, okay, we're buyers. So when you see the stock market overall having a bad day or a bad week or a bad month or a bad quarter, just a bad period, and they're falling in prices, look for the ones that are not falling. Look for the ones that are holding up the best, because you know what's going on there is that the institutions are taking advantage of that opportunity to accumulate. That's why you're seeing that bid. So when you see, so think of it like, you know, when you hold a beach ball in a pool and you're holding it underwater, right? The ball is pressing up against your hands, right? It's pressing up against your arms. You can feel that pressure. And when you let go, the ball shoots up in the air, right? In the stock market, it's the same thing. When you see stocks under pressure and a group of stocks or a sector or a stock is holding up relative to the rest, when that overall selling pressure gives out, which one do you think is going to be the first one to shoot up like that beach ball, right? You could see it in relative strength. That's evidence of institutional accumulation. And then there's information there as well. We're looking at crude oil hitting the highest level since 2014. And then notice how energy relative to the S&P 500 looks pretty much like crude oil. But crude oil looks a lot better. So it looks to me like the energy sector has a lot of catching up to do. And the beauty of it is that investors, particularly in America, just do not have exposure to commodities. They, you know, if you look at the NASDAQ 100, there is 0% weighting in energy, 0% weighting in materials, right? Zero banks for that matter, right? When you look at the S&P 500, it's less than 3% energy. Investors in America, particularly in America, when you look at other places like Canada and stuff where they're more natural resource in their economy than the US, they know that commodities are an asset class. But in the United States, investors have convinced themselves that commodities are not an asset class. And I can't think of anything more bullish for commodities than that.
Yeah, so here, even in India, also the ownership in energy sector as a whole is very limited, and that's what we are seeing over the last couple of days. A lot of these energy stocks have started moving higher, simply because that nobody liked them. They were like people you would stay away from them, and nobody would touch it with even with a 10-foot pole. So right now what we are seeing even in Indian markets and globally, all these energy basket stocks are moving higher.
Yep. And I think that that's going to continue because, you know, as an investor, as a retail investor, you don't have to worry about the benchmark and outperforming your benchmark. And that's fine, because what retail investors are doing doesn't really matter that much to the market. The institutional money flow, their outperformance or underperformance relative to a benchmark does matter. So if you are a hedge fund manager and you have $100 billion, $50 billion, whatever it is, $500 billion. If you are overweight technology and technology is flat or down in a month or in a quarter, and energy is up 12%, and you don't own any energy, you're in a lot of trouble. You're in a lot of trouble. And they know that, right? Investors are aware. It's not a secret. So the unwind of out of these growth tech that American investors have so much exposure to and into energy. And remember, the market cap of these massive technology growth companies are trillions of dollars. But these energy stocks have gotten killed over the years. These companies used to be 100 billion. Now they're 2 billion. So it's much more difficult to move a mountain than it is to flick a little rock, right? These little oil and gas stocks are little pebbles now compared to these massive mountains. So the moves are going to be, you know, oil goes to 100, you're going to see some of these energy stocks double or triple. I mean, that's what we're talking about, just because they're so small.
Yeah. So even though the move might be very small in the crude oil or natural gas, but the stocks which are involved in the businesses will eventually see a bigger move in their performance.
Definitely. Same thing with financials. You know, the big JP Morgan, Goldman Sachs, Berkshire Hathaway, these will do well if financials are doing well. But the little regional banks that are 5 billion, 8 billion, they're going to do very, very, very well.
Yeah. So this was JC Parets. In this episode, we've seen his life journey, how he entered the financial markets, and how he traded the 2008 market crash. After this, we have also seen his analysis and perspective on the US bond yields. And we have also seen how he transitioned from bonds to currencies and eventually to equities. We have also seen his perspective and views on Indian financial markets and Nifty and the broader markets as well. In the next episode, we'll dive deeper into his style of analysis, which is the top-down approach, and see how he analyzes various sectors as well as stocks within these sectors. So stay tuned and do look out for our episode next week. Meanwhile, please share this episode with your friends and family members and do subscribe to our channel as well. Thanks a lot and have a nice day.
Because once there's money on the line, once you have risk on the table, your emotions start shooting higher. It's perfectly normal. Very, very, very natural. But when your emotions are elevated, you don't make good decisions.